Being debt-free feels great, but it's not always smart. For many people, the dream of retirement isn't just about more free time, it's about freedom from debt. The idea of walking into retirement without a mortgage payment feels like financial peace of mind. But as with most things in personal finance, the math doesn't always match the emotion. In today's video, we're going to unpack whether paying off your mortgage before retirement makes sense. We'll look at the numbers, interest rates, and opportunity costs, but also the emotional and lifestyle trade-offs that come with being debt-free. But before we dive into all that, my name is Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. Let's start with the part that everyone understands. Having no mortgage feels great. It's simple, secure, and emotionally freeing. There's power in knowing that no matter what the stock market or interest rates do, you'll always have a roof over your head. For many retirees, that sense of security is priceless. Without a mortgage payment, your fixed monthly expenses drop dramatically, and that flexibility can make your retirement income plan much easier to manage. But emotions aren't the only factor. The financial side can tell a very different story depending on your interest rate, your tax situation, and how you plan to use your money in retirement. Next, we want to look at the financial argument, and we want to find out, what does your mortgage actually cost you? The first question you want to ask is, what is your after-tax cost of debt? If your mortgage rate is 3% and you itemize your deductions, your effective rate could be closer to 2 to 2.5%. Even if you don't itemize, 3% is still a very low cost of capital. Compare that to what your money could earn elsewhere. This year, conservative investments like treasury bills, CDs, and high-yield savings accounts are yielding between 4 and 5%. If your mortgage is under 4%, you're paying less in interest than you could earn in a risk-free asset, meaning you likely come out ahead by investing the money instead of paying down the loan, even in those low-risk investments. In other words, paying off your mortgage might feel good, but it could hurt your long-term returns. So next, we want to look at the opportunity cost, and we're going to just break this down with a simple example. So suppose you have a $200,000 mortgage and you're paying 3% interest on that annually, and you have 10 years left until that's paid off. Well, if you were to pay that off today, you would eliminate a $2,000 monthly payment. You're going to save roughly $32,000 in interest over the next 10 years. But if you would have invested that $200,000 instead, and let's say you earn a 5% rate of return on your investments, you'd earn about $129,000, $130,000 over that same 10 years. That's a difference of $97,000. And that's the opportunity cost of being debt-free, meaning it's costing you in this instance $97,000 more by paying off that mortgage as opposed to leaving that money invested. And of course, that assumes the investment actually earns 5%. If markets underperform or volatility spikes, that return advantage could shrink or even reverse. So it's not just the math, it's about risk tolerance and about how much certainty you want to have in your retirement picture. Let's look at this opportunity cost with a slightly different example. And that slightly different example is going to entail a higher interest rate. So we're going to assume the same $200,000 mortgage, 10 years left to pay it off, but your interest rate is 6.5% in this instance. Your payment is closer to $2,300 per month, and you will pay interest of $88,000 over the next 10 years. Assuming you pay a capital gains tax rate on your investments of 15%, you would have to earn a pre-tax rate of return by leaving that money invested of 7.65% just to equal the savings you would have from paying off the mortgage today. This is a much riskier portfolio than the one we described in the 3% mortgage rate example. It's doable to earn that rate of return, but you have to ask yourself, is it worth the extra risk? If the answer is no, pay off that note. If the answer is yes, well, let's start constructing a portfolio. So now that we've gone over the opportunity cost of holding your mortgage, let's also talk about how paying off your mortgage changes your liquidity picture. So essentially, that's how easily you can access your money. If you use the $200,000 of your savings to pay off your home, that cash is now tied up in a very liquid asset. You can't easily access it without borrowing against the house or selling it. That matters because retirees often face unpredictable expenses, healthcare costs, home repairs, or helping family out. Having a healthy cash or investment cushion gives you plenty of flexibility in retirement. One of the biggest mistakes I see people going into retirement make is that they're house rich and cash poor. They feel great owning their home outright, but suddenly have no liquidity to cover larger needs without dipping into their investments at a bad time. If you're considering paying off your mortgage, make sure it doesn't drain your emergency fund or leave you too dependent on market withdrawals. But also keep in mind that because you've paid off your mortgage, you're likely eliminating your biggest payment by paying off that mortgage. So if you can pay it off and free up a few $1,000s a month in expenses, that'll give you the flexibility that you want, and that's priceless. Just make sure you still have a little bit of a cushion in case bad times do come your way. That said, not every decision is purely financial. There's a psychological return to being debt-free. If your mortgage keeps you up at night, Or if you'd sleep better knowing that your house is 100% yours, that peace of mind has real value, even if it's something that you can't measure in real dollars. Some people are just wired to hate debt. Others see it as a financial tool. Neither mindset is wrong, but you have to know which one you are. The key is to make the decision intentionally, not emotionally. If you're risk adverse, paying it off would probably make a lot of sense in your instance. If you want to maximize every dollar and you have a lower interest rate, saving the money in an investment account could provide you with better long-term returns. But as with everything, let's talk about how taxes are going to impact all of this math that we're doing. Once upon a time, the mortgage interest rate deduction made paying off a mortgage early less attractive. But since the 2017 Tax Cut and Jobs Act, fewer people itemize because of the higher standard deduction. For 2025, the standard deduction is around $31,500 for married couples and $15,750 for single filers. This means unless your mortgage interest and other deductions exceed that amount, you're not getting much benefit from keeping the mortgage for tax purposes because you can't itemize. In other words, for most retirees, the tax deduction doesn't move the needle as much as it used to. The real analysis comes down to rate versus return. But now that interest rates are at some of the highest levels we've seen in decades, the math is starting to reverse. So assess where you are today, figure out whether you can itemize your deductions or not, and then find out what your after-tax rate is on your mortgage. That is going to be the basis for your comparison as to whether you should pay off that mortgage early or continue to invest that money and see if it's going to earn you more in the long run. So now that we've gone over the math and the emotional side of things, when does it make sense to pay off your mortgage early? Well, first is if you have a high interest rate. If your rate is 5% or higher, paying it off is a risk-free rate of return equivalent to that 5% or more. It's tough to beat that safety. Second, you have a low cash flow tolerance. If your budget is tight and eliminating a payment of a few $1,000s a month makes retirement more feasible, the cash flow outweighs the lost return. Plus, you can always reinvest excess cash flow that you get from the new mortgage savings. Third is you want to talk about whether you have a low or a high risk tolerance. If your risk tolerance is low and market volatility stresses you out, locking in the peace of mind from paying off your mortgage is going to be worth more than chasing higher returns. Finally, entering retirement debt-free by design. For some, having no liabilities is part of their retirement lifestyle philosophy, a mental and emotional clean slate that is hard to beat. But now that we know when it makes sense to pay it off, when might it make sense to retain that debt? Well, one is if you have a low fixed interest rate. If your mortgage rate is under 4%, the cost of borrowing is cheap compared to today's yields. If it's under 3%, you can likely earn more in a bank, money market, or savings account. It's tough to beat that safety. Second, you have strong cash reserves. If you have ample savings and investments, you don't need to rush to pay off cheap debt. Leave your money working hard for you. Third, let's talk about tax efficiency. You can deduct property taxes and possibly partial mortgage interest if you itemize, which lowers your effective cost of debt, meaning you have to earn less in your investment strategy in order to make more than what you would have through paying off the mortgage early. Finally, you might just have better uses for your capital. If your portfolio has earned returns of 6 to 7% annually, using cash to invest or fund Roth conversions can create more long-term value as well. Just make sure that you have cash flow to continue to support the payment. If you don't, prioritize that mortgage first. If you do, let that money roll in the market. There's also a hybrid approach that some of my clients do follow. You don't have to go all in on one side of the spectrum or the other. There's a middle ground that you can follow. The first thing you can do is a partial prepayment. You want to make a lump sum payment to shorten the loan term or drop future payments, but keep your liquidity intact. Check with your mortgage provider to see if they'll do something called recasting your loan, because when you do that, you might be able to cut your payment in half through this strategy. That frees up some liquidity for you now while also saving you money and interest on the mortgage itself. You could also look into doing extra principal payments where you add a few $100s per month toward the principal. It will accelerate your payoff without draining your savings. You could synchronize your payoff with retirement as well. Set a goal to have your mortgage gone by your retirement date and pay it down gradually until you get there. Finally, you can reinvest the payment savings. Once you're mortgage free, redirect that old payment or a portion of that old payment into investments or savings to keep growing your wealth. The hybrid approach gives you emotional wins of progress without financial rigidity of the full payoff. This is something that I often talk about with married couples because what I find is one spouse might be very aggressive while the other one's a little bit more conservative. This is a great best of both worlds strategy to keep everyone happy to live the retirement dream that they want to have. Let's go over a brief case study. So we have Jim and Karen, and they're 62, and they're both planning to retire at age 65. They owe $200,000 on a 3% mortgage with 10 years of payments remaining. They could pay it all off now using cash from their brokerage account, which earns roughly 5% annually. If they pay it off, they'll save about $32,000 in interest. If they invest instead or leave that money invested instead, their money could grow to about $229,000 over the next 10 years, roughly $97,000 more than they'd save in interest. But here's the nuance. Jim's retiring from a stressful job, and Karen likes the idea of not worrying about bills. They decide to pay off half their mortgage now and keep a $100,000 balance, and then they leave the rest invested. Their payment drops through a recast, their liquidity remains intact, and they both feel comfortable with that balance. That's the kind of mindset most retirees should aim for, optimizing for both money and mindset. So what's the bottom line here? Paying off your mortgage before retirement isn't just about the numbers. It's about risk, flexibility, and peace of mind. If your mortgage rate is low and you have a strong investment plan, you're likely better off leaving that money invested and letting it work harder for you elsewhere. But if being debt-free gives you emotional relief or makes your retirement income cash flow picture more predictable, paying it off can absolutely be the right move. The smartest decision is the one that supports your lifestyle and your financial confidence, not just your spreadsheet. If you want help modeling both scenarios, the math of keeping versus the math of paying off your mortgage, that's exactly what we do here at Nav Wealth Partners. We will help you find the right balance between peace of mind and long-term opportunity. Thank you so much for watching, and as always, make smart money decisions.